Hello and welcome to Options Guide TV. My name is Brian Overby. Today on Options Guide TV, we're going to probably spend about 25 minutes, and we're going to start by just looking at our Broadcom trades that we did. We looked at a couple of potential trades. We looked at a very short-term skip strike butterfly, and we also looked at a short term where we straddled the stock long call spread. So after AVGO's earnings, and that was part of the reason why we were leaning towards the skip strike butterfly on the show. One of the biggest things was we just couldn't get it done for a very solid net credit. We were looking, we brought in about 20 cents when we did our skip strike butterfly, and I'm showing it to you right now as we look on the trade. We have AVGO stock was at 259 when we put it on. The total net credit received was around. The goal was to get at least 20 cents or better, but we ended up getting it done for around 18 cents if we did it during the show at that point in time. We had the stock at 259.94. Our peak of our skip strike butterfly was right at the 285 mark, and the stock never came close to it. The company announced earnings, and as soon as they announced earnings, the market went down, and this would have been trading for next to nothing. And the expiration date was on the 6th. Now, if we did the straddling of Broadcom, where we went and we looked at buying a just in the money option contract, which was the 250 the 250 strike, and then sold the 270 strike. That gave us a lot more upside on it. It was a 17.5 point wide spread that we did, and at this point in time, that if you didn't get out of the trade, obviously we did it on the 6th, you had opportunities to get out of the trade and be okay, because we did straddle the stock, and the stock wasn't well, let's put it didn't drop precipitously. In other words, you could have gotten out of it. You had opportunities to get out and salvage some of your investment on that trade if you did the long spread. Ultimately, the trades that I like around the earnings, and we're going to look at another one today, is in the skip strike era, because it's really hard for stocks right now to try to break out to all new highs. And as long as your name is, the only stock that's doing it is Netflix, and for some reason they're the darling of the stock market right now. But especially in the semiconductor space, there's still geopolitical concerns. We're going to look at our NVIDIA trade, which is doing just fine, but we bought a deep in the money, longer term call option in NVIDIA. But before we do that, here, let me run back to the Tradier Pro software. And here is what happened in Broadcom, and we'll zoom in a little bit on this corner here. Show you a little bit of the move across the board. So prior to the earnings, we're right around 265. We dropped down to around 250. Our long strike was $252.50, and then we continued to drift lower, and we ended up, right now we're at 246.25 at this point in time, and as far as Broadcom is concerned. NVIDIA, though, is looking solid. NVDA, we got a big move to the upside today. So far, we do. We're at 144.40 in NVIDIA, and we bought a deep in the money call option. We went out to the November expiration, November 21st, 2025. We looked at the 115 strike call. So let's see how our call option is doing. The stock, when we put the trade together, was right around 140 at the time. So we should be up about a little bit more than half of that on the trade, because we had a delta of about 80 when we put the trade on NVDA. And we're going to stay the course with this one. We might be selling some we might sell some stocks against, or sell some covered calls against the position as we go through time here. I don't think I want to do it at this point in time, but I'm okay with the concept of it. Yeah. So the stock, we put it on for, well, then we must have been a little bit lower when we put that stock on, because we put it on, we paid 115 strike right here. We paid $30.50 for this call option, and it's now trading, we'll call it 37, and a nice solid, I love the fact that we got 15-point wide spread on a $36 option. That's awesome to see that type of open interest in that tight of a marketplace. So that's where we're at. We're up about $6 on that position, and this was an alternative to buying the stock outright. And in my mind, it was a double up to catch up trade. So the way that I kind of bill the NVIDIA trade, and we're going to hold this position, we obviously have 165 days to expiration. The way I kind of build this is, if you've owned NVIDIA for a while, and let's say you don't have the capital to buy another 100 shares to do the double up to catch up, this is a great way to do it. Go out, buy NVIDIA, fixate your risk to the downside. 30 points, NVIDIA has already moved that ever since we had the tariff discussion. So we've had it well over a 30-point move to the downside. That would be your max risk on the trade. You're obviously getting extremely well. You're getting something that's acting a lot like the stock. We're getting very solid movement. The option contracts are trading for 36. We put it on for 30, so we're getting a lot of stock price representation, and it's an opportunity to, well, NVIDIA was struggling and figuring out exactly where they're going to be geopolitically. A way that you could participate in that downturn and do a double up to catch up strategy. And we've done more than one of those, because we've had quite a few of the we looked at also at a covered call on steroids, where we actually bought one call option and sold two call options against it, 1x2, also known as a front spread. But if you had the underlying stock, that second call option is covered by that 100 shares of the underlying stock. So I'm happy to see NVIDIA back towards the 144 level. The downturn in NVIDIA, if we go back and let's look at the chart in NVIDIA, the first downturn right here, that's where we're back to. This is when the DeepSeek news came out, and it was determined, maybe they don't need as many NVIDIA chips in the world to do AI. So the stock came down. This is where we did our first double up to catch up, and we sold something right around, I think we sold it right around the 145 level. And we had a long call option from 140 to 145, and it didn't quite get called away. Then we had the stock come all the way back down to 195. And now we're back all the way back to where we began. So it'll be real interesting if we can break through the 152 level. And that's part of the reason why I don't want to sell a call option at this point in time. I think that if we can set a new recent high here in the underlying stock, I do think that you're going to see some more momentum to the upside. This would be an area right here, would be an area where I wouldn't even mind buying a long call, just at the money or a little bit out of the money long call, see if we get a little bit more momentum if we do break through that level. All right. Now, today, keeping with the earnings season, I did find a stock. I mentioned on the show that we're coming to the end, but I found a stock that I do think is quite a bit overvalued. Chewy, the pet store, they're announcing earnings, and the stock right now is quite a bit overvalued. Looking at the numbers across the board, we see that their forward PE right now is trading at about 72 times earnings. The revenue numbers aren't looking that solid across the board. And if you look at the chart, it's just been parabolic. CHWY, and And I think if there's anything bad that is mentioned, even a slowdown, there's going to be a heck of an opportunity to just get bearish. And look at the move since the breakout here, right at 140 or at 40. I'm sorry. Underlying stock has ran 10% since that point in time. We're trading actually more than 10%. We're trading at 46.47. And if you look uh, at the money straddle, that's trading for $4.30 or about 9%. So I want to do a butterfly. I want to do a short-term butterfly. I'm not going to do a skip strike butterfly because I actually think that it will be more bearish than we think if the turnout is any fluctuations in the numbers are going to be a little bit scary in this scenario. But I'm looking at doing just out of the money, buying the 46 strike put option, and we're going to be using the nearest term expiration here. So let's go out to the 13th, highlighting the earnings. Look over here. This is the 13th. We got 4 days until that expiration date. So very easy, very simple, very straightforward earnings trade in Chewy. The earnings are going to be after the close on Wednesday. So we'll actually be able to look at this trade a little bit on Wednesday's show, but I want to put it together right now. We're seeing some weakness in the stock already, down around 4% at this point in time. So I want to take this opportunity to get into the trade. Implied volatilities are high. We're trading at 106% implied volatility, means butterfly is going to be cheap, and it is. So the at the money option contract, if you bought this is trading for $2. We're going to put this butterfly on for 76 cents, and we're going to do the open wing butterfly. So we're going to be buying the 46 strike call. We're going to sell 2 of the 43 strike calls that are $3 down. And then the fact that we got half point strikes makes this simple. It makes the ratio pretty straightforward. We're going to buy the 41.5 strike call. We still got decent volume, decent open interest. I'm not quite sure why we have half point strikes. It's a little bit crazy to me, but these are liquid option contracts. So especially around earnings. So I like this trade at this point in time. Now, the open interest on the half strike is a little bit lower than the other ones. But if we're coming in as a butterfly, we shouldn't have any problem filling this. If we send this to the what if calculator, and I've already done that, I'm going to pop over here and we'll scroll down. Here's our trade. We're putting it on $46.34. If we see the underlying stock, what we need it to do, if it goes down about the expected move, just around 4 points. Well, we're right around 4 points to the downside. 4.3 is the expected move, and we land somewhere in the middle. This is our sweet spot on our trade. We could sell it for as much as $3. That would be the maximum that you would receive on it. It's a short-term trade. But they are announcing on a Wednesday. You got all day Thursday, all day Friday in order for this trade to play out. And then if we break all the way below the 141.5 strike, our lowest strike in our butterfly, well, we've opened the wing. We're able to get this done fairly cheap, 76 cents. So because of that, we anywhere below 41.5, which would be at this point almost double the expected move, right? So double the expected move would be $8.30. So we're talking maybe a 1 standard deviation move to the downside. We could make it'll be fixed that we would make $3 on the trade. We'd pay 76 cents for the trade. So in that instance, we would be up around $72. And right here, you're kind of seeing the numbers right at this point in time. But bottom line is if you put this on, you got a 3-point wide max upside. And then if we blow through the strikes, we get a 1.5. We pay 76 for that. We're up $76 on the trade. I like the setup. Now, the only other thing that you could do if you wanted to do the Chewy trade is this is an alternative to a bear put spread where you just buy something fairly close to where the underlying stock is and sell something way out of the money. And you give yourself a little bit more potential. But if the expected move is around $4, I like to try to target something around that expected move to the downside. We're at 40, yeah, 40. That's perfect. So $4.30. So we were talking about 42 is right about where the expected move is at from where it's at right now. So we're definitely within the range of our butterfly if we land somewhere about the expected move to the downside, and we're paying 76 cents for it on an earnings trade. So I like this trade. I like this trade around the earnings. Now, you can wait and you could put it on by Wednesday. The stock is overvalued and the stock was down today. So I kind of like putting it on today. Normally, I would say let's wait until Wednesday, but market's a little bit top heavy, and this stock has just had too big of a run up. Now, they could come out and they could blow the numbers, and I always want to emphasize that when you're doing earnings trades, there's nothing written in the as if when you're doing an earnings trade, you still have to have the earnings report match what your outlook is. Even sometimes when you don't have the earnings report, like Tesla recently, when they came out with probably the worst earnings report that they've had in a long time as far as growth, sales, and everything. But you still had the stock run up just off of expectations on what they might be doing in the robotics field. So it's always tough around earnings. Just keep that in mind. But that's why I want to manage my risk a lot. 76 cents here. I'm not going to buy as many of them as I possibly can. I'm limited dollar amount. I personally will probably put on about 5 of these to the downside. 5 by 10 by 5 is the ratio that I like on it, going around 76 cents. And we'll see. It's prime that they're going to have to be perfect on their earnings report, or it's just prime for a little bit of a give back in the underlying stock. Now, if you have any comments or questions or concerns, please let me know. And all you got to do is just put them in the chat box, and I will try to address them. If not, I am traveling this week. I will be back on Wednesday. We will look at this trade. We'll see where the trade is at, and maybe we'll look at an adjustment or look at a different trade that goes around the Chewy position. But if not, and I don't see any comments right now, so we'll see you this Wednesday, 11 a.m. Eastern Time, for the next edition of Options Guide TV. Thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.